Welcome back to our channel. Are you ready to dive into the insights of top financial minds?
Absolutely. Today we're summarizing the essential viewpoints of experts like Jim Rogers and Rick Rule.
They touch on key topics like the U.S. debt crisis and how it could affect your investments.
Not only that, but we're exploring investment strategies in agriculture and commodities.
Plus, we'll discuss the emerging trends in Bitcoin and its potential.
So stay tuned for concise summaries that cut through the noise.
Let's kick it off with Jim Rogers and his latest investment recommendations.
And don't miss what Rick Rule has to say about the future of commodities.
Remember, this is all educational content, not investment advice. Kohl's just warned that holiday shopping will be worse than expected.
Exactly. And they aren't the only ones. Target and Best Buy also echoed these grim sentiments.
So does this mean a bleak holiday season for retailers?
Brace yourself, as the signs point to significant challenges ahead for consumers and retailers alike.
The forecasts reveal that consumers are feeling squeezed by high prices and stagnant incomes.
Absolutely. Even major retailers are adjusting their sales expectations downwards.
It's fascinating yet concerning to see how deeply these trends affect holiday shopping.
And it raises important questions about the underlying health of the economy.
Kohl's stock took a 20% hit, marking its lowest since 2020.
It highlights a persistent trend of declining expectations among major retailers.
Is this a sign that the holiday season might be a complete bust?
It certainly suggests that consumers are tightening their belts significantly. Reports show that October income growth wasn't strong enough to combat inflation.
Isn't it ironic? While some expect spending increases, the reality shows stagnation.
So consumers are trying to make do with less.
Exactly. Many families are now planning to cut holiday budgets drastically. This cyclical downturn isn't just about underperforming holiday sales.
It's indicative of a larger economic issue. Most consumers are tightening their budgets.
So, what's really driving this consumer behavior?
It's the combination of stagnant wages amid rising costs.
What do you think is next for retailers like Kohl's?
Well, if current trends hold, we may see a continued decline in retail sales and even more markdowns.
That could create a tough environment leading into the new year. It's becoming clear that shoppers are likely to remain budget conscious this season.
Indeed, consumers are setting a limit on spending, which could reshape the retail landscape.
Would this change how retailers strategize for the future?
The crucial takeaway here is that retailers must pivot swiftly.
And that means understanding consumer behavior intimately to stay afloat.
In this unpredictable climate, flexibility is key.
The market's momentum shows signs of shifting. Let's dive into Christopher Mullen's insights.
Exactly. He provides a detailed outlook about not just the S&P 500, but also Bitcoin's next moves.
Is this really the time to be bullish? I wonder how tariffs will play into this.
Great point. Mullen digs into how these elements can drastically affect investor sentiment.
Mullen emphasizes that psychological levels, such as 6,000 on the S&P 500, can trigger profit-taking.
Right, and the ongoing tariff discussions make the tech-heavy Nasdaq particularly vulnerable.
What's the takeaway for average investors watching this?
Prepare for movements. Understanding these factors can shape your next steps.
So Chris points out that traders often set sell orders around critical thresholds like 6,000.
Does that mean we could see a dip after reaching those points?
Absolutely. It's all about managing risk when prices hit these psychological barriers. So Chris isn't optimistic about tech stocks in light of continued tariff pressures.
That's a valid concern. With tech holding a massive portion of the Nasdaq, any disruption can trigger market shifts.
How should investors prepare for this kind of volatility?
By relocating resources and being cautious about which stocks to support.
Bitcoin is showing strong chart patterns, but Mullen warns of resistance around 100K.
He believes there may be significant selling pressure once it hits that mark.
So should investors hold off entering the market?
Not necessarily, but they should watch for price action very closely. Mullen sees January as a crucial month where the market dynamics could change swiftly.
Interesting. Is there historical backing for these claims?
Definitely. Patterns from previous elections can often reveal similar outcomes.
Mullen suggests that small caps may benefit from the current climate.
What's driving that optimism?
Smaller firms are generally less exposed to tariff-induced risks, offering a safe harbor.
To sum up, Mullen's advice is pretty straightforward. Watch those levels carefully.
We could be facing substantial shifts, especially come January.
Remember, timely decision-making is key to navigating this environment.
Did you hear the staggering new data? The U.S. government's liabilities have exceeded a shocking $136 trillion.
Rick Rule dives into this debt crisis, linking it to a bullish outlook for precious metals.
But if there's so much debt, can gold really thrive in such a scenario?
That's what we're here to discover, especially now with Rick's levels of insight on commodities.
Rick believes current debt levels will inevitably lead to a higher demand for gold.
Interesting. He claims that gold merely needs to revert to its historical market share to drastically impact its price.
So, are we seeing a gold rush at this point?
Not yet, but if history indicates a consistent pattern, we shouldn't dismiss it.
Rick highlights that subtracting public debt leaves us with minimal private wealth.
Indeed, this unsustainable leverage hints at a looming crisis.
So what's the alternative then?
A flight to safe haven assets like gold becomes increasingly likely, in Rick's view.
Can inflation truly be managed without causing harm?
Rick suggests that a degree of inflation is virtually unavoidable.
Absolutely. The strategy will likely involve inflating away obligations, much like the 1970s. Wow, gold has a historic performance that many overlook.
Right, it's about understanding its real value, not just price peaks.
But are people really recognizing gold as a viable investment?
Awareness is growing, but we're still below historical market capitalizations.
So Rick envisions a profound shift by 2025.
Exactly. He believes a return to historical norms is on the horizon.
That escalates the urgency to consider gold as a key asset.
He predicts a significant shift in where investors place their money.
Right, this could fundamentally alter market dynamics in favor of commodities.
To summarize, Rick stresses gold isn't just an investment, it's a lifeboat amid financial storms.
And inaction could prove risky if the economic tides turn.
Absolutely. Timing is everything, especially in today's climate.
Next, we'll dive into the shaky state of our economy with Dr. Anna Wong.
She'll reveal critical insights on what looming unemployment may mean for markets.
Don't miss it. It's bound to be a critical discussion.
We're diving deep with Dr. Anna Wong to assess the state of the economy as we approach a new presidential administration.
Right. Anna's here to break down the disconnect between stock market optimism and the troubling labor data.
Isn't Wall Street too focused on election outcomes? What about the underlying economic indicators?
That's a crucial question. Let's hear Anna's take.
So, Anna, you see significant risks lurking beneath the surface despite recent market rallies?
Absolutely. The fundamentals show signs of a cooling job market.
That's alarming. Does this mean we should be preparing for a downturn?
Exactly, viewers need to understand the implications of these dynamics.
The labor market appears weaker than reported, right?
Yes, Anna discusses significant downward revisions indicating trouble ahead.
What does that mean for the average worker?
More uncertainty and potential job losses, especially post-elections.
Anna emphasizes that tariffs could have complex effects on the economy.
So, we're not just looking at inflation.
No, the impacts on employment and profits are significant considerations. What strategies should investors consider based on her insights?
Dr. Wong suggests a cautious approach. It's time to reassess risk.
Are precious metals and real estate looking more attractive?
Indeed, diversifying into assets that typically withstand downturns is wise.
So what's Anna's outlook on unemployment going forward?
She sees it rising significantly with ongoing labor market challenges.
What should everyday consumers do in preparation?
Being proactive in financial planning could be essential for stability. The crucial takeaway is that a shaky economy necessitates smart financial moves.
Exactly. Knowledge and adaptability can help mitigate risks.
It sounds like cornucopia this holiday season could be overshadowed by market realities.
It sure can, but true resilience comes from being prepared.
Don't miss our next video featuring Jim Rogers discussing his unique market insights.
He'll offer perspectives that could redefine how we view these turbulent times.
Stay tuned for what promises to be a compelling analysis.
With inflation still a potent force, Jim Rogers believes we're on the precipice of a significant market shift.
Absolutely, and Jim's unique perspective is remarkably enlightening. He discusses cutbacks, inflation, and his cautious stance on investments.
But can we really avoid a crisis? Or are we just delaying the inevitable?
Jim emphasizes the importance of recognizing the signs before it's too late.
Rogers warns us that the euphoria surrounding market growth masks deeper economic troubles.
Right, he draws parallels between today's environment and previous financial crises.
What evidence does he provide to stress the urgency of this message?
He cites historical patterns and present indicators that suggest a storm is brewing.
Inflation isn't going anywhere soon, according to Jim. Why is that?
He points to relentless money printing and ongoing supply chain issues.
So, is it safe to say consumers will continue feeling the pinch?
Exactly. Prices are rising and wages aren't. It's a tough environment. Jim has cut back on his investments, seeing limited bargains today.
Interesting that he's emphasizing selectivity. Why is he particularly keen on China and Uzbekistan?
Those markets present unique potentials, despite broader concerns.
Yes, but he addresses that even these might not be safe long term.
Rogers often highlights the staggering debt issues. How serious is this?
He describes it as an unsustainable situation, portending future crises.
So, what are the likely effects of this crisis?
Increased taxes, higher interest rates, and potential currency issues.
So what does Jim envision for the financial landscape?
He foresees the need for caution as the bubble grows.
And is he hinting at an opportunity amidst the chaos?
Yes, he sees value in understanding trends to navigate uncertainty. Key takeaway: manage your financial risks and be informed about the market.
Indeed, preparation is crucial in these uncertain times.
So in the end, it's about knowledge and strategy.
In a world filled with grand promises from the UN, how do we realistically address humanity's needs?
Dr. Bjorn Lomborg challenges the notion of doing everything by suggesting we should focus on what truly matters.
But can we really optimize limited resources to tackle such immense global issues?
Let's unravel Dr. Lomborg's revolutionary insights through his compelling research.
Lomborg asserts that promising everything equals asking for more money, a strategy doomed to fail.
He's advocating for a shift in perspective to focus on actionable priorities.
But how do we determine the most impactful areas?
By considering cost-benefit analyses of various initiatives, we can strategically allocate resources.
Dr. Lomborg highlights that effective health interventions can save millions at a low cost.
Yes, it's about smart spending. Every dollar spent on TB could return $46 in benefits.
How can we convince stakeholders to support these initiatives?
They need to see the undeniable evidence of their return on investment.
Education plays a pivotal role in economic upliftment.
But isn't building schools a more traditional approach?
Building schools is good, but we need to prioritize effective learning methods.
Lomborg's research shows that tailored learning can dramatically enhance productivity for a fraction of the cost.
Foreign aid often gets caught in bureaucracy with limited results.
Exactly. And Lomborg suggests we reallocate resources based on proven outcomes.
Why is there such reluctance to change allocation strategies?
Politicians prefer popular projects over data-driven solutions, which often yields less impact.
Moving forward, Dr. Lomborg predicts a strategic pivot in how funds are allocated.
Countries might finally prioritize smart investments that yield real impact.
It sounds optimistic, but how likely is this shift to happen?
With growing awareness, I see it as an inevitable evolution in policy. To summarize, prioritization can lead to massive improvements with limited resources.
It's not about what we promise, but how effectively we deliver.
And that requires a shift in thinking around global aid.
Exactly, informed decision-making is the key to maximizing benefits for all.
Engage with us in the comments. What are your thoughts on how we allocate resources?
Your feedback could influence the discussion and decision-making processes.
Don't forget to subscribe for more thought-provoking content from What the Finance.
What an enlightening mix of perspectives we had today.
Indeed, Dr. Lomborg really challenged us to think about how we allocate our resources.
Right? His focus on cost-effective solutions is a refreshing take.
And of course, Jim Rogers brought a sense of urgency with his warnings about rising rates.
It's hard not to feel the weight of those concerns. Dr. Wong's note on labor market weaknesses is sobering.
Exactly. But what struck me was how Rick Rule connected those debt concerns to potential gold prices.
Yes, his prediction about gold reaching $10,000 really got my attention.
And Christopher Mullen's insights into market momentum really tied it all together, didn't they?
Absolutely. It's clear we need to stay agile and informed in this ever-shifting landscape.
If you found value in today's discussion, please give us a thumbs up and subscribe.
Your support means we can keep bringing you these crucial insights.
Thank you for tuning in. Don't forget to explore our channel for more valuable content.